Let's talk about the retail strategy where Nedbank is concerned and what you have on that front.
Yeah, so certainly, if you look at Nedbank's franchise, we're very strong on the wholesale side of our business. We're probably a number 2 or number 3 market share player across the piece, whereas our retail business is our smallest franchise. I think perhaps what's most important, though, is that on the deposit side of our retail business, we do have the number 2 market share. And certainly what the global financial crisis has taught everybody is the importance of a very powerful retail deposit franchise, which we're very fortunate to have. I think the key challenge for our retail business going forward is this business has been run over the last few years on a very, what we would call product-centric basis in product monolines. And Ingrid Johnson and her team are busy working on what we would call a much more inclusive strategy of client centricity and trying to put the client at the center of our retail experience as opposed to the product.
Mike, a number of the market commentators that I regularly discuss the banking sector in South Africa with on the Business Tonight news desk do say that you are trading at a significant discount to the other 3 big banks. Can you unlock shareholder value, in your opinion, and perhaps even re-rate Nedbank?
Yeah, certainly we do think we can. We do trade on a lower price to book, as you correctly say, and that's a wonderful opportunity because we have that growth ahead of us. If we look at our business and try and say, what do we think the underlying reason for that is, it's primarily because we know that our franchise generates a lower level of what we would call non-interest revenue than the peers. All of our other financial metrics benchmark very well, but non-interest revenue is generally seen as being of a more stable quality, as well as it requires less capital. So in that sense, it's the type of income that produces a higher return on equity, and therefore our return on equity is slightly lower than the peers and our valuation is lower than the peers. So what have we done about it? Because that's clearly the key job of a chief executive and the management team. The first thing we've done is we've set some targets around non-interest revenue now. When we released our results in February this year, we set a target for non-interest revenue to be greater than 85% of our expense base. At the moment, it's running at around 78%, so we've got quite a lot of work to do there. But the first piece that we've done towards fixing that would have been the acquisition of the bank assurance businesses from Old Mutual. Previously, those were equity accounted as associates. They're now wholly owned, so we think that those over time will give a strong boost into non-interest revenue, as well as enabling us to sell a much broader product set to our customers. We've also used the opportunity last year to buy the 50% of Imperial Bank that we didn't own, and again we think that that base gives us an opportunity to improve our non-interest revenue positioning. We've spent several hundred million rand over the last few years on improving our transactional banking systems, primarily in the wholesale space. We've rolled that out now to all of our business banking customers, and we're in the process of rolling that electronic banking platform out to our corporate customers. So again, we see some opportunity there. And then by the time we get to the end of this year, we'll be ready to roll that out to our retail internet banking customers. So we've got quite a lot of exciting things on the table to try and close that non-interest revenue gap and therefore the valuation gap.
You mentioned Imperial Bank. Is that transaction completely bedded down now, and are you extracting the synergies that you initially set out to?
The transaction is going enormously well. It is wholly owned by Nedbank now and fully accounted for as wholly owned. We are waiting for something called a Section 54 approval, which enables us to integrate the bank, and we'd probably expect that sometime in the 2nd or 3rd quarter of this year. But I think we've been enormously pleased how the transaction has progressed so far, and in particular how well MFC, which is their vehicle business, has done over the last few months in terms of the volumes going through that business. There's been absolutely no drop-off in volumes, which is clearly the key risk in any merger environment.
When the financial crisis hit, there was much debate as to whether we would see a corporate default, particularly in South Africa. Do you think that that risk is now over?
So I think it would probably be a bit early to say the risk is over, and we would remain cautious over the next couple of months. I think generally speaking, internally in South Africa, we know that we have an environment where consumers are reasonably highly geared and our corporates on a global basis are relatively lowly geared. So it didn't surprise us how well corporate South Africa came through the cycle. I think what we'd be watching very carefully now is that generally as a cycle slows down, working capital requirements in corporates reduce. So in fact, corporates produce cash. And it's only as the cycle begins to pick up again that corporates are likely to consume cash. And I think that's where we'd be very careful around the possibility of a later cycle default in corporate.
The South African consumer, we're sitting at a debt to disposable income of still around about that 80%. Do you think that we're going to see that ratio becoming a little bit more pleasing, specifically to banks out there, as we see a healthier South African consumer, or is that still going to take some time, given the level of job losses that we're still seeing in South Africa?
So we still think it will take some time. We think that, rightfully so, the consumer is cautious at the moment, having taken a lot of pain when interest rates moved up to 15%. So debt to disposable income, you quite rightly say, is sitting just below 80% at the moment. And we certainly see amongst our consumer base that any excess cash that they have at the moment is being used to repay debt or to build up some savings, as opposed to people going out and investing in, for example, houses and growing our mortgage book. So I think it's a natural phenomena. Our current outlook is that the consumer should start to feel a little bit more confident about life into the second half of this year, and then perhaps we can only start to see some reasonable growth in our consumer businesses into 2011 and 12.
We see the repo rate currently sitting at the lowest level since inflation targeting was introduced. If you were South African Reserve Bank governor, would you cut interest rates again?
No, I think that interest rates are at an appropriate level at the moment, given where inflation is. So I think that the outlook for interest rates is flatter for longer, and I think that's pretty much in line with the Reserve Bank outlook at the moment. So I think they've done a really good job over the last couple of years.
Is there something that keeps you awake at the moment?
I think the thing that keeps us awake at the moment would be the fragility of the global recovery. And as I touched on earlier, if there is a slowdown in China, a strong knock-on effect from the sovereign debt crisis in Europe, or in fact, indeed, if interest rates in the developed markets increased substantially, I think it would be very tough from an economic perspective in South Africa. That being said, we know that our banks came through the previous crisis in astoundingly good shape. And what's really interesting is that all of our banks, as we sit here today, are in better condition than when we went into the global financial crisis. So if there was another problem in the world markets, I have no doubt our banks would survive very, very well through that crisis again.
Mike, you are passionate about banking. That's very, very clear. What else are you passionate about?
So certainly I would be most passionate about my family. They're quite simply the most important things in anybody's lives. And it's a tough balance. To have a job like this and
you jumped the question, next question, because you know everybody asks you about balance. How do you get that right?
You should probably ask my wife, because she'll probably tell you I don't. But it is very, very tough to do, and I think you've got to try and make sure that you spend the bits of quality time that you get as best as you possibly can. So I'm very passionate about my family. I do thoroughly enjoy golf. It's interesting, neither Tom nor Richard Loebscher in fact played golf. And clearly Nedbank is the sponsor of the Nedbank Challenge, so that's a big thing in our lives. I love wildlife, so I enjoy getting to the bush whenever I can. And we're very fortunate to have a holiday home on the north coast of Natal, which is an area of the country I absolutely love. I spent lots of time there as a kid growing up, and I love the beach.
Is business still done on the golf course in South Africa?
I certainly don't think that a significant amount of business is done on the golf course. A lot of relationships are built on the golf course. I don't get a lot of time for that type of golf at all. In fact, the golf that I enjoy the most at the moment is playing with my 10-year-old son. Who's
had the biggest impact on your leadership style and your corporate career to this point? Some would expect you to say Tom Boardman.
Yeah, I think there's been a number of people who've been very impactful over many years. I started my career many years ago auditing banks when I was working for Deloitte. Very fortunate to work for Vasi Naidu and a gentleman called Dave Gibbon at that stage. And they certainly had a very strong early influence in getting me into the banking stream. And then as I moved through various organizations, in NBS and BOE days, I worked for Paul Leafright, who certainly was a very strong influence and enormously clever man. And then more recently Tom, as you quite rightly say.
5-6 years out, where do you see Nedbank, and what legacy do you want to have in place?
So I'm absolutely clear on the legacy that I would like to leave in place, and I think the job of any chief executive is to leave behind a better organization than the one he inherited. So certainly I need to make sure that the organization grows and is built in a way that is sustainable for the next 20, 50 or 150 years. If we look 5 years out, I think what we'd like to see is an improved competitive positioning on the retail side of our business without giving up at all of the strength of our wholesale side. We'd like to see significant improvement in what we would call our transactional banking franchises, both in wholesale and in retail, and we'd like to see some progress on our strategies further north into Africa.
How long do you think a CEO should be at the helm of a company?
It's a very difficult question. I think what international experience will say is that probably somewhere between 5 to 7 years is the appropriate time for a chief executive to be at the helm of an organization.
But you've got a lot of longevity in the corporate arena, so perhaps you're going to have a longer lifespan.
Absolutely. I've been remarkably fortunate to get to this position in my mid-40s. So hopefully I will have a longer tenure than that.
Mike, thank you very much for your time.